Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, sterling heads for its worst performing month since Liz Truss's mini budget last year. As well as that, Amazon is being accused by the Federal Trade Commission that it is using anti-competition techniques to hurt consumers, hurt sellers, and hurt other competition within the market. As well as that, we've got lots to talk about on the charts, which we'll come to near the end, as well as lots of data coming out today. So make sure to stay around to see that at the end. But let's get straight into it. First, talking about sterling heading for its worst month since Liz Truss's mini budget. Now, sterling fell to a 6-month low against the dollar yesterday, therefore putting it back on track to have its worst month since Liz Truss's mini budget. Now, I'm sure many of you can think back to the time of Liz Truss's mini budget and the effects that it did have on the markets, especially in relation to pound and the gilt market, so UK bond markets. Now, the primary effect of this announcement was that the pound sold off greatly, and this was the result of increased borrowing rates that were expected by a high spend, low tax economy, which she promised through that mini budget. Cutting higher tax brackets and also promising greater spending. This, as a result, obviously caused the effect of a crashing pound, which did recover actually after about a day. However, it did crash, and this is kind of the prior low where the sterling is now heading, which is very, worrying, especially considering the times that we were, betting on the sterling. When the sterling did reach levels, those levels seen during Liz Truss's mini budget, it was far more kind of tolerable. However, considering the economic situation at the moment, it's sort of surprising and bad for the UK to have such a weak currency. Now, the position for the pound amid fears that higher interest rates will plunge the UK economy into the recession. So this kind of, as I just said, this all comes as a result of people kind of fearing, number one, that these increased interest rates by the Bank of England, which is now sitting at 5.25%, it's now feared that by having these rates so high, growth is going to stunt so much by these increased borrowing rates that in fact will fall into a recession, therefore of course requiring the heavy stimulus through quantitative easing and other inflationary measures, which may hurt the pound even further. And so this is kind of like looking ahead within the markets around the current news. But as well as that, we'll come to it more coming to the end of this article. But there's also obviously, the current and most recent news from the Bank of England in relation to keeping rates where they were, which is kind of, poor in the short term for the sterling, as people were kind of expecting, an increase in rates, which obviously would cause an increase in interest payments for those holding pounds in, deposit accounts and that sort of thing. And therefore, when they found out that, rates weren't going to go as high as they previously thought, they were able to move their money into other currencies, such as the dollar, which is seemingly becoming a safe haven asset during these economic struggles that we're experiencing globally. Now, the pound has slipped 7.2% since mid-July, with the Bank of England also surprising investors last week by holding rates at their current levels following 14 consecutive times. So this is what we're really talking about there, but it is so significant, finally pausing rates after 14 consecutive rate rises. And this, this kind of signal to many that we have actually reached the end of our rate hiking cycle, which obviously means that if you're holding money in the pound, this is the most interest you're going to be receiving, and therefore there was just less hot money flowing into the pound, and therefore driving the pound even lower amid a stronger dollar, which we'll come to in a second. Now, markets are now pricing in a 50% probability that there will be no further increases in the interest rate. So as I said, most people prior to that release and prior to the inflation data, which caused rates to stay where they are. Prior to all of that, it was expected that rates were going to reach very high levels, and we'll come to it in a second, but rates were even expected to reach 6.4% by the end of this year. So, much higher than we're currently sitting, and therefore a lot of the money within the pound, was expecting to receive that interest rate at some point in the future. And now that people are finding out that they might not actually experience that level of interest on their money in the pound, everyone's taking their money out the pound essentially and putting it in the dollar, which has got some more like hawkish news in relation to the Federal Reserve, which is looking to possibly raise rates at the end of this year. And that's in contrast to other central banks which people might put their money into, like the ECB, which has lower rates than both banks, but also is looking to be at the end of its rate hiking cycle, similar to the UK. Now, this was as I said, a staunch change from markets in July, predicting rate levels to reach around 6.4% this year. So a very large difference to where we're at right now. And this was the result of inflation and growth data at the start of the year, providing resilient and therefore, being resilient, and then therefore people kind of expected higher interest rates were needed in order to bring that inflation down that was being so resilient, as well as, the really strong economy at that time. And this is in contrast, in contrast to the start of the year. However, recent inflationary data has shown that rates are having a strong effect on the markets. And you would have heard this last week, especially when we were talking about that data release, really. I think it was on last Wednesday, so, near exactly a week ago now. But we were talking about how, inflation came in far below expectations, with core inflation being really key in, showing that inflation was going down, and therefore, rate hiking was no longer an issue that needed, concern, and no longer an idea that needed to be, thought on anymore and acted on, anymore. Now, this obviously had a strong effect on the markets, with this recent low inflation data therefore signalling to the Bank of England that rate increases aren't necessarily needed. Because if inflation is coming down at the rates that we're at right now, why raise them further and hurt the economy more than you need to, is essentially what the Bank of England's, come across. That said, guys, it's not necessarily on the article, but we need to remember, that how split the decision was within the Bank of England, with Andrew Bailey, the spokesperson and leader of the Bank of England, having the deciding vote on the matter. So it really isn't, this whole side of the Bank of England all supports, keeping rates where they are and possibly bringing them down soon. It still is a very split matter within the Bank of England, and so it's not a case of just ruling out any more interest rate increases. And as a result of the lack of need to raise rates further, this has kind of left the UK closer in line with the expected pathway of US interest rates. Data showing the UK's economic growth slowing has also led the Bank of England to believe that rates are working effectively, with the UK's economic activity, as measured by the Purchasing Manager Index, falling this month at the quickest pace since January 2022. So there's definitely signs that the UK economy is slowing down growth-wise, and therefore interest rates are having the effect that they need to cool the economy down, which was very hot coming out of lifting COVID restrictions and the quantitative measures that were implemented during COVID. Now, gross domestic product also follows this trend, which fell 0.5% between June and July. So there we go. This kind of sign that the economy is cooling. It is kind of regressing momentarily, in line with the Bank of England attempting to raise rates to a point where inflationary issues are kind of squashed. Sorry. Now, the fall in the sterling's value is a vast change. From the first half of 2023, when the pound was the best performing currency of the G10. This is great contrast to now, when it's declining to levels seen only most recently with the Liz Truss mini budget. So it's, quite a large change, but it shows how much, interest rate predictions play into the value of a currency, with all of that money going into the pound and driving it to be the most best performing currency of the G10, because rates were expected to be the highest for the pound. Now HSBC and Nomura predicted that weak pound would fall to $118 over the next 3 months, sorry, which is a large change from the previous prediction of $1.24. Now, as a result of the global slowing economic growth, the dollar has made gains as it's being used now as a safe haven currency, and this is unsurprising to us, considering the whole globe is experiencing this kind of global market slowdown, issues around inflation, issues around growth, lots of stagflation, lots of supply issues, lots of export issues, and now the rising oil problems which are in the mix has all added to making the dollar a great asset to have your money in, due to higher expected interest rates, and just generally it being a safer currency than the rest in the world. But that's moving on from the pound. We'll talk about it also on the charts a bit later on, so stay around till then. But next to talk about really is Amazon, which has been using monopoly power to hurt consumers, rivals and sellers, which the Federal Trade Commission alleges. Now, the US Federal Trade Commission and 17 states have sued Amazon, alleging the online retailer illegally uses monopoly power to overcharge consumers. And this is, quite a significant matter, really, not only because, Amazon's one of the largest stocks, but also because of how many people really use Amazon. I'm sure many of you use Amazon on a monthly basis, with even some of you using it on a weekly basis. And so this kind of level of issues around antitrust obviously is on the top of many people's radar. Along with that, states are arguing that Amazon is attempting to hobble inflation hobble competition, whilst exploiting its sellers on the marketplace. With an increasing number of people selling their products on Amazon, this obviously is a large issue to combat. And Amazon has been accused in the lawsuit of increasing fees to sellers on its marketplace, so that it extracts nearly half of every dollar of revenue made by sellers. So really trying to squeeze out the value of every seller and every sale that's made on Amazon. Amazon is also accused by the Federal Trade Commission of punishing sellers that heavily discount discount heavily, by making them effectively invisible in searching results, therefore forcing them to use Amazon's advertising. And if you look any product really on Amazon, and you kind of try and find one which generally has a wide array of competition, very perfect competition almost, indistinguishable differences between the products, you'll kind of actually find it's quite hard, if you already know what's the cheapest brand of that exact product, you'll find it actually very hard to find that product unless it's being advertised, simply because it isn't bringing in the revenue which a more expensive product is, or Amazon can just get them to pay for the advertising so that they make the sales on that product, and therefore Amazon can bring home a buck. Now, the lawsuit is one of the biggest tests yet of the Federal Trade Commission's chair, Lina Khan's more aggressive enforcement stance towards big tech, with this being a very strong antitrust kind of policy position. In 2017, Khan rose to prominence with the 2017 academic paper calling for the breakup of Amazon. So obviously, some argue, including Amazon, is arguing that she's kind of approaching this with a very biased viewpoint, and therefore the kind of validity of her arguments are obviously coming into question. Now, Dave Zapolsky, Amazon's senior vice president of global public policy and general counsel, said the lawsuit makes clear that the Federal Trade Commission's focus has radically departed from its mission of protecting consumers and competition. Obviously here he's trying to note that possibly the Federal Trade Commission has been corrupted by bias, especially left-wing bias in relation to these issues around Amazon. Now, to maintain a monopoly, the Federal Trade Commission said Amazon uses a sophisticated surveillance network of web crawlers that monitored whether Amazon sellers were offering their products cheaper on other sites and punished sellers that did so. So, quite worrying stuff if you're, someone that's trying to use Amazon as your marketplace, as your livelihood. If you're finding out that basically they're forcing you to only use Amazon and you can't actually allow for a free market to exist where people can kind of choose between, or at least have a greater choice on where they buy your product from. Now, the Federal Trade Commission is seeking an order to permanently stop Amazon from engaging in the alleged illegal conduct, and Amazon has led previous lawsuits with the Federal Trade Commission, paying $25 million to settle a lawsuit as a result of being charged with violating children's privacy laws via its Alexa voice assistant. Now, moving on, that's all for our articles, but next to talk about really is the charts, with firstly US indices falling lower. Now, we've been talking about US indices a lot recently, and that's largely to attribute to the issues around the US economy, as well as rising US interest rates, which are expected by the end of this year. And once we received that kind of information from Jerome Powell around possibly increasing rates last year, we saw this massive sell-off in US equities, which is now most recently on the US 30 reached these levels of 33,660. So, a large fall of around, if I could get up the percentages, I would. But yeah, a large fall in the percentages that once, the US 30 once stood at up here. But yes, US indices have sold off. But on the opportunity of course, any indices sell-off, you obviously have the opportunity to get on the retracement if you still believe the fundamental picture is to the downside. And with, speculation still being that basically the Fed is going to raise rates later this year, it does seem that until any contrarian, data comes out, contradictory data comes out, it does seem that it will be a bearish position on US indices and US equities, and therefore, a sell side retracement position would obviously make sense. And so I've kind of marked out this 38.2% Fibonacci area on the retracement tool, which is in line with this prior low, which was broken through after being tested, and was then retested, but not fully. I guess, not much liquidity had been punched before it moved lower. So I still would expect some move to the upside before continuing much lower. And this is the same sort of situation on the US 100, on the Nasdaq. I kind of drew out this kind of trading pattern in relation to what we were seeing, a kind of squeeze in the market where there was some area of support and, a high level of upside liquidity, whilst, a general trend to the downside as prices were kind of being squeezed on it following this fall to the downside. And now it does seem that we've broken lower, breaking below this area of prior resistance. And so it'll be interesting to see now whether it will retest this 38.2% fib, which is kind of in line with this area of support and liquidity. We've also seen that fall on the US 500 as well. But next to talk about really is the dollar, which is making new highs. And once again, that's unsurprising with the Fed's reaction to inflation and the economy, and talking of raising rates later this year. Pound USD, going back to what we spoke about at the start of the video, obviously it's making new lows, and it's just been pushing to the downside. As you can see here, pound dollar usually does range a bit, moving around and not falling off too much, but it does seem that it's taken a really hard turn whilst the dollar gains and the pound feels weak following the Bank of England's decision to keep rates where they were following inflation data. And so it's broken below these prior lows, and it's kind of falling into the abyss now, not into areas not seen since March earlier this year. So it's not looking too good for pound dollar. But next to talk about really is gold, which has found liquidity seemingly on the downside. And for me, I'm kind of seeing this as more, I mean, it's hard to really judge, but you could argue that there's a strong bullish picture here. Now, whilst there was kind of the more sell and short positions that I was speaking of earlier this week, where I kind of said it's likely to take a fall from this 38.2% fib following the data coming out from last week. I've now kind of changed my picture in the long-term view after we've reached these prior lows now, and kind of created this double bottom and reaching this area of liquidity previously seen and created on June 2023. We've definitely pushed the downside, reaching this area on the Fibonacci retracement chart of 78.6%. And so I would expect, some sort of positive and bullish reaction from this. And if we look fundamentally, I mean, we're having global issues in relation to markets, and it does seem as, in addition to that, that rates are seemingly coming down for most nations. That said, the dollar is receiving a lot of money as a result of being a safe haven asset, but you have to look at the trade-off of how much money could actually go into the dollar before it makes more sense to just put your money in gold. So the fundamental picture for me is looking slightly more bullish than usual on gold, in contrast to earlier this week where I kind of saw it as a more bearish position, and this would kind of be an area which I wouldn't be surprised we see some bullish movement from. But next to talk about really is the Amazon stock, which obviously in reaction to these issues around being a monopoly and having these lawsuits, as well as the the macroeconomic data and decisions by the Fed last week, we've kind of seen this sell-off on Amazon after reaching highs at 145, not seen since August 2022, but we've seen definitely a sell-off and sort of reaching this area of liquidity where we've seen 4 kind of tests of this area, once the upside and then 3 times using it as support. But let's see whether it can break through and head lower and kind of head into the abyss a bit, and see where it turns out for Amazon. But next to talk about and finally to talk about really on the charts is US oil and oil in general, which although was rallying greatly in line with a fundamental picture of Saudi Arabia and Russia trying to achieve the $100 a barrel oil mark, it does seem that it did retrace and was ranging about. Not much was happening with it, but it does seem now like it's punched liquidity and possibly may make a move to the upside after nearing this 61.8% Fibonacci line, as well as punching that liquidity. And this was also seen on Brent crude oil, which punched this prior area of resistance and liquidity and has now made a significant move to the upside. So it'll be interesting to see what comes out of that. But next to talk about really is the economic calendar, with lots of data coming out today, with firstly the Bank of Japan's monetary policy meeting minutes, which will obviously have a grave effect on any yen pairs such as pound yen and USD yen, which is in an interesting position, but not too much happened yesterday, so not too much to talk about on those two pairs, as well as the Aussie monthly CPI indicator, along with Chinese industrial profits figure, which is coming out, and that's a year-on-year figure, as well as German consumer confidence, which is obviously going to have a grave effect on the euro due to being such a large economy within the eurozone. Once again, remember, German data has been heavily affecting the euro's policy, the ECB's policy recently, and the eurozone economy, with issues around the German manufacturing sector obviously having a great effect on the markets around that sort of area, and has also contributed to the ECB holding rates where they are for now and possibly looking to bring them down not too soon as a result of declining manufacturing in Germany. As well as that, we're getting the ECB's non-monetary policy meeting, as well as German 10-year Bund auction, as well as the US 30 mortgage rate figure coming out, along with the mortgage applications figure coming out as well. And finally, we have US durable good orders, which is a month-on-month figure. So lots of data coming out today, lots is happening on the charts as we've covered, and two really important articles going into today's trading day this Wednesday. Hope you have a great trading day though. That's all from us at Wildwood Capital, and yeah, see you later. Bye.